$64 billion, gone. Vanished into thin air while regulators looked the other way for nearly 3 decades. And that's just one scam on this list. By the end of this video, you will understand how billionaires, banks, and billion-dollar companies pulled off the biggest thefts in modern history. Some went to prison, most did not. And the craziest part? Several of these scams are still happening legally right now. We are covering 12 catastrophic frauds that cost everyday people trillions of dollars. Let's get into it. We are not just an energy company, we are revolutionizing how markets work. That is what Enron told investors while secretly building one of history's most elaborate frauds. Enron started boring natural gas pipelines, nothing sexy, but in the 90s, they transformed into an energy trading powerhouse that everyone on Wall Street worshipped. The secret sauce was hundreds of shell companies designed specifically to hide catastrophic losses. Call them special purpose entities, fancy terminology for financial magic tricks that made debt disappear from their books. But the real genius move was mark-to-market accounting. This accounting method let Enron book future profits from deals as revenue today. Imagine your boss paying you right now for work you might do 5 years from now. That is essentially what Enron was doing, except with billions of dollars. For years it worked. Enron's stock soared. Executives bought mansions. Wall Street analysts called them visionary. Then the house of cards collapsed. When investigators started asking questions, Enron's accounting firm, Arthur Andersen, literally started shredding documents. Not quietly, frantically, industrial shredders running around the clock as federal agents closed in. The result, stock crashed from $90 to under $1. Thousands of employees lost not just their jobs, but their entire retirement savings, which had been heavily invested in Enron stock. About $74 billion in market value evaporated. The silver lining, this disaster gave us the Sarbanes-Oxley Act, which completely overhauled corporate accounting regulations. Cold comfort for people who lost everything, but at least something changed. Right when America thought corporate fraud could not possibly get worse than Enron, WorldCom said, watch this. WorldCom was America's second largest long-distance phone company. Massive, trusted, and it was running an $11 billion in accounting fraud, the largest in U.S. history at that time. The scam was almost stupidly simple. Companies can capitalize long-term investments, spreading the cost over many years. Think of buying equipment that will last a decade. That is legitimate accounting. WorldCom took regular operating expenses, stuff like maintenance fees and line costs, and reclassified them as capital investments. It is like claiming your grocery bill is a home renovation project and telling your accountant to spread it over 10 years. This fraud made their profits look astronomically higher than reality. For years, nobody caught it, until one internal auditor, Cynthia Cooper, stumbled across irregularities while investigating something completely unrelated. 1. Curious employee brought down a company worth more than $100 billion. WorldCom imploded. 30,000 workers lost their jobs. CEO Bernie Ebbers was sentenced to 25 years in prison. Investors learned the hard lesson that bigger does not mean safer. I've got a special investment strategy that delivers consistent returns of 10 to 12% every single year, regardless of market conditions. If anyone ever promises you this, sprint in the opposite direction. This was Bernie Madoff's pitch, and it destroyed thousands of lives. Madoff ran the largest Ponzi scheme in human history, $64.8 billion worth of pure fiction. Here's how Ponzi schemes work. You take new investor money and use it to pay returns to earlier investors. No actual investing happens. No stocks, no bonds, just new money paying old investors until the music stops. What made Madoff's scam particularly disgusting? He targeted people who trusted him. Wealthy individuals from his social circles, charities, and Jewish community organizations. This is called affinity fraud, exploiting personal connections and shared identities. The scheme ran for nearly 30 years. Here's the part that will make your blood boil. A financial analyst named Harry Markopolos figured out it was mathematically impossible for Madoff to be legitimate. He warned the SEC repeatedly, starting in 2000. They ignored him for 8 years. The scheme only collapsed during the 2008 financial crisis when too many panicked investors tried withdrawing money simultaneously. Madoff could not pay. The illusion shattered. He got 150 years in prison. Thousands of victims lost everything. Charities shut down. And Madoff's own son Mark committed suicide from the shame and devastation. Can't afford a house? No income? Terrible credit history? No problem. Sign right here. The 2008 housing crisis was not just one scam. It was a catastrophic layer cake of interconnected fraud that nearly annihilated the global economy. Step 1. Banks handed out mortgages to literally anyone. No documentation, no verification. People with zero income got $500,000 loans. These were called ninja loans, meaning no income, no job, no assets. Step 2. Banks immediately sold these garbage mortgages to Wall Street investment firms. Step 3. Wall Street chopped up these toxic loans, mixed them together, and repackaged them as mortgage-backed securities. They marketed them as safe, reliable investments. Step 4. Rating agencies like Moody's and Standard & Poor's slapped AAA ratings on these financial time bombs, the same rating as U.S. Treasury bonds. There was a massive conflict of interest. The agencies were paid by the banks creating the securities. Step 5. Predatory lenders specifically targeted lower income and minority communities with deceptive loans, offering teaser rates that seemed affordable and then ballooned to unpayable amounts. When housing prices stopped rising and people started defaulting, the entire system imploded. The damage was $10 trillion in lost housing wealth, millions of foreclosures, tens of millions of jobs lost worldwide. And the most infuriating part, almost zero major executives went to jail. Instead, banks received taxpayer-funded bailouts because they were too big to fail. Privatize profits, socialize losses. That was the lesson of 2008. Just months after Madoff's arrest, another massive Ponzi scheme detonated. Alan Stanford's fraud was worth about $7 billion. Stanford promised incredible returns on certificates of deposit through his bank in Antigua. He targeted investors across the United States, Latin America, and the Caribbean. Where did the money actually go? Private jets, a cricket team, a private island. Stanford lived like a Bond villain while stealing from retirees. What made this particularly cruel? Unlike Madoff, who mostly scammed wealthy investors, Stanford specifically targeted middle-class people and retirees looking for safe investments. And once again, regulators failed spectacularly. The SEC suspected Stanford was running a Ponzi scheme as early as 1997. They took no meaningful action for 12 years. Stanford eventually received a sentence of 110 years in prison, but victims recovered pennies on the dollar. Their life savings vanished into Caribbean bank accounts and luxury yachts. Wells Fargo pulled off one of the most brazen frauds in banking history, and they did it hiding in plain sight. Between 2002 and 2016, Wells Fargo employees opened over 3.5 million fake accounts without customer knowledge or consent. Checking accounts, savings accounts, credit cards, all completely unauthorized. Why would they do this? There was intense pressure from management to hit unrealistic sales quotas. Employees who did not meet targets were fired, so thousands resorted to fraud just to keep their jobs. The scheme boosted Wells Fargo's stock price by showing impressive growth in new accounts. They charged fees on these phantom accounts. When employees reported the fraud through the company's ethics hotline, many were fired in retaliation. Wells Fargo paid $3 billion in fines and settlements. Their chief executive officer resigned. Their reputation imploded. But here is the thing. This was not rogue employees. This was systemic corporate culture that incentivized fraud from the top down. In 2015, one smug face showed America exactly how broken pharmaceutical pricing really is. Martin Shkreli bought the rights to Daraprim, a 62-year-old drug that treats a potentially fatal parasitic infection. The next day, he raised the price from $13.50 per pill to $750 per pill. That was a 5,000% increase overnight. for a drug that costs about $1 to manufacture. Shkreli knew that patients with this specific infection had zero alternatives. They needed the medication to survive, so he could charge whatever he wanted. The most infuriating part? This was not illegal. It was completely legal under American pharmaceutical law. Shkreli eventually went to prison, but not for price gouging. He was convicted of securities fraud in an unrelated case involving his hedge fund. The Daraprim price is still over $500 per pill today. Shkreli did not create this system, he just exposed it, and that system is still operating exactly the same way. Imagine an entire nation getting looted by its own prime minister. That is One Malaysia Development Berhad, known as 1MDB. Malaysia Development Berhad was supposed to be a sovereign wealth fund for economic development. Instead, Malaysia's Prime Minister Najib Razak and his associates stole at least $4.5 billion from it. Where did the money go? Luxury penthouses in New York, a super yacht, millions in jewelry for the Prime Minister's wife, and fine art. They even funded the Hollywood movie The Wolf of Wall Street, a film about financial fraud. Major banks like Goldman Sachs helped raise money for 1MDB, earning almost $600 million in fees while apparently ignoring massive red flags. Goldman Sachs later paid $2.9 billion to settle investigations. The scam was partially exposed because Razak's stepson, Joe Low, could not stop flaunting his wealth. He partied with Leonardo DiCaprio, dated models, and bought a $250 million yacht. His Instagram was basically a confession. Najib Razak was sentenced to 12 years in prison. Joe Low fled and remains at large. Malaysia is still trying to recover billions of dollars stolen from its own people. Elizabeth Holmes claimed she would revolutionize blood testing. One tiny finger prick could run hundreds of tests, replacing traditional blood draws. Major problem. It didn't work at all. Holmes raised over $700 million from investors and built Theranos into a $9 billion company on paper. She appeared on magazine covers, got compared to Steve Jobs, assembled a board packed with heavy hitters like Henry Kissinger and James Mattis. Theranos even partnered with Walgreens, setting up blood testing centers in stores. They ran tests on real patients using technology that was dangerously inaccurate. When Theranos employees raised concerns about faulty results, Holmes and her partner Ramesh Sunny Balwani intimidated and threatened them. They created a culture of secrecy and fear. The scam collapsed when Wall Street Journal reporter John Carreyrou published an expose in 2015. Holmes was eventually convicted and sentenced to over 11 years in prison. But this was not just financial fraud. Theranos gave thousands of people dangerously wrong medical test results. Results that could have led to improper treatments or missed diagnoses. That is not just stealing money. That is endangering lives. Wirecard was supposed to be Germany's tech success story. It was a payment processor valued at over 28 billion euros, and it even replaced Commerzbank on Germany's prestigious DAX 30 index. One small issue: 1.9 billion euros of their cash did not exist. It was a phantom shortfall. For years, Wirecard claimed this money sat in Philippine bank accounts. The Philippine bank said they had never heard of Wirecard. The Financial Times investigated Wirecard's suspicious activities for years. Instead of taking those warnings seriously, German financial regulators investigated the journalists for market manipulation. When the fraud finally came to light, Wirecard collapsed overnight. CEO Markus Braun was arrested. COO Jan Marsalek disappeared, reportedly fleeing to Russia, possibly with help from intelligence services. The most embarrassing detail was that Ernst & Young, one of the world's big four accounting firms, had audited Wirecard for a decade without spotting the fake accounts. This was not just corporate fraud, it was a complete failure of Germany's financial regulatory system. How does one person lose $20 billion in less than 2 weeks? Ask Bill Huang of Archegos Capital. Archegos was not technically a scam, more like spectacularly reckless gambling with borrowed money. Huang used something called total return swaps to hide his massive stock positions from regulators and even from the banks lending him money. Instead of buying shares directly, he made deals with multiple banks to pay him returns on certain stocks. Each bank did not know how much exposure other banks had given him. Huang was essentially using 6-to-1 leverage, controlling $160 billion with just $20 billion. When some of Huang's stock bets started dropping, banks demanded more collateral. He could not pay. This triggered a massive fire sale as banks dumped his positions simultaneously. Viacom CBS lost over 50% of its value in days, so did Discovery. Credit Suisse lost $5.5 billion. Nomura lost nearly $3 billion. The best part? Huang had already been banned from trading in Hong Kong for market manipulation, yet major international banks still gave him billions in credit with almost zero oversight. This disaster helped push Credit Suisse toward its eventual collapse and takeover in 2023. Sam Bankman-Fried's entire image was performance art. The shorts, the messy hair, the "I'm just a nerdy, effective altruist persona," all carefully crafted bullshit. FTX was supposed to be a legitimate cryptocurrency exchange. Behind the scenes, it was chaos, theft, and fraud. The scam was shockingly simple. FTX secretly transferred customer funds to Alameda Research, the trading firm run by SBF. They used customer money to make risky investments, cover Alameda's losses, buy luxury Bahamas real estate, and make massive political donations. When crypto prices fell and customers tried withdrawing their money, FTX could not pay. They were running a fractional reserve with customer funds. The company collapsed, owing over $8 billion. Until literally days before the collapse, SBF was celebrated as a genius. He appeared in Super Bowl ads with Tom Brady. He testified before Congress as the face of responsible crypto. Major venture capital firms invested hundreds of millions. The fraud was so obvious in hindsight that people are still asking, how did nobody see this? SBF was convicted on all counts and faces decades in prison. But the money, most of it is gone. Technology evolves, financial instruments get more complex, but the scams, they're always the same. Promises of returns that seem too good to be true, lack of transparency, pressure to invest quickly before you miss out. If you do not fully understand where the money is going, there's a good chance it is going into someone else's yacht. The other pattern? Regulators almost always fail until it is too late. The Securities and Exchange Commission ignored warnings about Madoff for 8 years and about Stanford for 12 years. German regulators investigated journalists instead of Wirecard. The system is not designed to catch fraud early. It is designed to look busy while the rich get richer. If you found this valuable, subscribe and turn on notifications. Understanding these scams is the best defense against becoming the next victim.